So thank you all for coming out tonight to this webinar. It's really essentially teaching us or teaching everybody how to invest with what's known as an FHA loan. I personally have used this loan before, so I'm pretty familiar with it. Today we have two fabulous and also fabulous guest speakers. If we can move to the presentation slide, or if we can move to the introductory slide, please. All right, so we have our fabulous guests tonight who are from Fairway. We have Mr. Mike Swaley, who's a branch manager at Fairway, as well as Steve Dickoss, who's a loan officer at Fairway as well. So I'll let you guys take it off. My name is Jeff Badu. I'm a licensed certified public accountant in the state of Illinois. I'm the owner and practitioner of my firm, Badu Tax Services, and we specialize in tax preparation, tax planning, and tax representation for individuals and businesses. So really, as I was saying, today's webinar is really to teach everyone how to invest with an FHA loan. What is an FHA loan? Different ways you can get it. We have, if you need one, we have people who provide it right here today. And like I said, I've invested, or I've bought a property at least with an FHA loan, and I'm actually closing on a 3-unit property tomorrow. So I would like to pass the mic to Mr. Mike and Steve. So please go ahead and take it away.
Thank you, Jeff. Appreciate you having us, and thank you for getting this put together, and for inviting people to join and to learn about what we have to talk about today. So I'm Mike Swaley, as Jeff said. I'm the branch manager of actually the St. Louis branch of Fairway, and I know people are joining us from all over the country. Our branch lends pretty much everywhere from our little group here in St. Louis, all the way from California to Florida to New York. We've sort of done it all. So I have Steve Dickoss joining me. He is our resident FHA expert, and I'm going to pass the mic to him to start off this presentation, and I'll just be kind of interjecting along the way. Steve?
Thanks again, Mike, Jeff, for help putting all this together. Good afternoon, guys. Excited to dig into some fun facts about our FHA multifamily unit properties and how to get into some of these homes and accumulate wealth with little down payment. So what we're going to go over tonight is just a brief overview of what the FHA loan has to offer, what a multifamily home is, reasons to invest in a multifamily home, and reasons to invest in real estate, and then why use Fairway.
Sure, and I just want to add that this is a pretty specific and short presentation. We'll probably be through the slides here, the formal part of it, in maybe 10, 15 minutes. And then we're going to open it up to questions and to be able to talk more freely about some of the things that interest you guys and some of the questions that you have. So this presentation is specifically about using the FHA loan, which is not commonly thought of as an investment vehicle, but using that program to actually acquire a multifamily in which you would reside in one unit and be able to lease out the other units to either make a profit or at least cover your payment. So go ahead, Steve.
Yep, and before you continue, Steve, I'm sorry, but if you guys do have any questions, we do have a chat box. So there's a chat feature if you're using your phone or if you're on a computer. There's a chat feature. If you have any questions, comments, anything you need repeated, please feel free to shoot them out there. So please go ahead and fire away. But we will have a formal Q&A session after the presentation is over. So sorry to cut you off, Steve, but please go ahead.
Oh, thanks, Jeff. All right, so really, what is the FHA? Federal Housing Administration it's a government-backed loan that allows us to get into multifamily unit properties with as little as 3.5% down for your down payment. Typically, when you're purchasing these investment properties, the down payment requirement is a lot higher than 3.5%. So to be able to get into one of these units as a primary residence for you, and to be able to rent out your other units with as little as 3.5% down is a value add in using this program. The program has great rates in comparison to some of the other pricings that you'll see on investment property. It's very flexible on what kind of guidelines that qualify a buyer with this program. So, you know, you can get into one of these properties with as low as a 600 credit score, and in certain occasions we can get exceptions granted for as low as 580. But the flexibility in being able to go with an FHA loan is also consistent with other things like a debt to income ratio. Lenders work off of heavily on what kind of income that you have in comparison to what debt that you might have. And with the FHA loan, there's a little bit more flexibility as long as we have an approval through our system on how high we can actually go with some of those liabilities. So the only other thing I would say is there's no income limitation on the other end of the spectrum there on how much you are making in order to qualify for one of these loans.
Yeah, that's a great point, Steve. A lot of government programs do have income restrictions. This one does not. I also want to go back to the rate portion of this. A little known fact is that because there's mortgage insurance and because it's a federally underwritten program, your rate is probably lower than what you're expecting if you were to use a conventional loan for the same purpose. So not only if in a conventional loan would you require a 25% down payment to buy a 4-family, for example, but your rate could be up to 0.5% lower. And we'll talk a little bit more about that later.
Awesome. So as we were talking about, there's no limits for what kind of income qualifying that you guys make to qualify for this loan with a lot of other government programs there are. There are loan limits. So what's important to know about these loan limits is they change based off of property type and also the county that you're purchasing in. So we got a little proactive here and pulled up outside Cook County, and we're going over the single family loan limit in Cook County is $365,700, right? So basically 3.5% down, as long as your loan limit is below the $365,700, you can use this low down payment. So if you look across the spectrum here from 1 to 2 to 3 to 4 units, you can see these loan limits increase. Again, a major pro in the FHA loan would be the fact that you can get all the way up to $700,000 plus and still use a 3.5% down payment to occupy one of these homes. You know, in investing, the key part of what you want to look at is what your cash is on hand and what you have tied up in this investment. So for our St. Louis viewers here, you can see our top box is a little bit lower. We've got 294. 515 for our single family units, and then again 3.5% down, going all the way up to the 566,425 on our loan amounts for up to our 4 units. So next we're gonna talk.
The only thing I'm going to add there is that we usually like prettier graphics, but we actually wanted to show you if you were to go and if you're in a different county to this URL down below and actually look up what you can expect to see and how to read it.
Yeah, and this is where we would love to step in, and if you guys are looking in different counties, really help guide and do this back end work for you. You know, the main point that we want to drive home here is just that there are loan limits depending on the county and depending on what property type you're actually looking to purchase. So moving right along here, just going to talk real quick on what actually a multifamily unit home is. You know, it's a connected building. All the units are under one roof. In this scenario, we would occupy the home in one unit. The other 1 to 3 units would be rented by your tenant, and everybody's got their own access to their own unit, and the walls will be shared. The only thing that I would highlight and emphasize here is that for this program, FHA, for the multifamily home, we are staying below 4 units. Anything in the mortgage industry typically above 4 units is considered commercial. So when we look at a multifamily unit home, we're talking 1 to 4. Again, if you're going above a 4 unit home, you're probably looking in a commercial space or commercial lending. So why buy a multifamily home? Why start your investment with one of these? So there are a bunch of good reasons that we thought of with Jeff and Mike, and you know, I think one of the great things that you're getting is obviously tenants that are going to be paying your mortgage and paying your way to gaining equity and gaining that wealth from buying your home. Why not start and when you purchase your first home, start that investment process right away. You can leverage your tenants in diversifying your rental stream, so it's a less risk on you, and you obviously have a lot more control over who and what tenants that you have. So,
hey Steve, I have a quick question. So why would you say a millennial, let's say most of our listeners today are millennials. So what would you say is a benefit? Why should a millennial actually be interested in something like an FHA loan versus, just renting like most millennials do?
That's a great question. That is a great question. I'm glad we thought about that. So yeah, I'm actually a millennial myself, and this kind of hits home for me. And when I kind of look back in perspective and look at what kind of investment tools that we have access to, I think they're going to be limited compared to where they were in maybe the generations before us, when they had pension plans from their employers, when they had Social Security income, was going to be something that's going to be potentially limited for us. So being forced in, I use that word lightly, but being forced into an investment and living in one, it forces you to gain equity and invest. It can be tough as a millennial to contribute to that 401k or that Roth IRA or whatever you're looking at, but having this in play as a millennial, the time's on your side here. If you start something in your mid-20s, 30-year loan is going to be paid off by your tenants, mind you, before you're ready to look at retirement, mid-50s, late 50s potentially. So as a millennial, I love the idea of having somebody else pay for my mortgage. I think it's a little bit less of a risk than what you could potentially see in the stock market as well. You're not looking at $100,000 bouncing up and down every other month. The real estate industry, I think, is a little bit more stable than something that when you're looking at your liquid investments. So I think Mike's got something to add to this as well.
Yeah, I do want to just acknowledge that landlordship, if that's what you want to call it, is not for the faint of heart, right? There is risk, but there's a whole lot of reward. And it is a little bit of work if you want to do it yourself. And this idea of buying a multifamily home as your potentially first property that you get to live in as well as rent out, I think that's a heck of a way to enter home ownership, but also, like Steve is saying, the investment game, building towards your retirement. There's a huge trend, if you want to call it that, sweeping the nation right now called, a lot of people call it FIRE, financially independent and retiring early. This is a great first step towards that. And if people want to talk about that, we can talk about that more later.
Yeah, and the only other thing that I'd love to highlight as we're talking in benefits and investing in real estate and as in a millennial is just the tax incentives that one of these would help you with how you're able to certain write-offs and cash flow that's going to help you accumulate wealth at a higher rate than if you did not have something in play.
All right, real quick, we had a few people that joined within the last 5 minutes. So just to catch everybody up real quick, this is a pretty short presentation, and then we'll get to a longer Q&A. So don't feel like you missed out. You'll have the chance to ask whatever questions you need to. But what we're talking about here is basically using the FHA program to acquire a multi-unit property that you can then live in and then rent out the additional units. It could be a 2 to a 4 unit, living in one, renting out the other 1 to 3, with as little as 3.5% down, with rates that are below the conventional levels usually, which is not something that people know. Let's go ahead and get back to our next one.
Yeah, so Mike, I don't know if you've seen, but we did have a question that came in. And the question is, do you all have a reference for good properties besides Zillow?
That is a great question. And Federico, I will echo what you said. I'm in this industry. I look at people's finances and do mortgages and properties every day. But if I were to go and look for a multi-unit, I would hire a realtor and send them to do that work for me. And there's a number of reasons that I would do that. One, expertise of the neighborhoods. If you're looking at neighborhoods, different neighborhoods where you don't necessarily live or don't know a whole lot about, they're going to have that expertise. Number two is time and specialization. I took a lot of economics in college, and my time is best used doing stuff like this, and a realtor's best time is used best by finding properties for people like us, right? Do you want me to go through the rest of these questions now, Jeff, or hold them to the end?
Yeah, we can go through the rest of them. One thing that I did want to mention is that a realtor is actually free of charge to the buyer. I think that's one thing that some people don't actually know. That don't actually pay for the realtor. It's the seller that pays for the realtor. So,
correct.
Some people might think, oh, I'm hiring this realtor, I'm going to pay him a bunch of money. A realtor is actually free in most cases, at least, probably 99% of the time, for the buyer.
That's exactly right. You know what? These are pretty quick questions. We'll just go ahead and answer them right now and then get back to the rest of them. So restrictions on obtaining multiple FHA loans at once. Yes, there are. You can only use an FHA loan once. There are a couple caveats, exceptions to that, but they're pretty specific and pretty tough to qualify for. So I think it's best to just operate on the assumption that you can only have one FHA loan unless you meet certain criteria.
Yeah, and you do not need to be a first-time home buyer to use an FHA loan. Again, there's some certain other caveats that you need to meet, but no, to answer that question directly, you do not need to be a first-time home buyer to obtain.
That's a good question, and it's a common misconception that you do need to be a first-time home buyer. You don't. You just don't. You just can't have one already.
Right.
The last thing I wanted to say regarding reasons to invest in real estate as a millennial. There's a book I read and that I make a lot of people in my branch read called The Slight Edge. And one of the core philosophies of that book is that huge gains are not often made all at once. And even when they appear to be made all at once, it's usually because small things happen on a daily basis for years leading up to that large breaking point. So if you're younger, and even if you're not, you doing little things like acquiring an investment property and earning just a little bit of excess income every month off of that rental property, you look up 5, 10, 15, 20 years down the road, and you'll be surprised at how far you've gotten. And it'll certainly be farther than if you never started. So sometimes taking that pressure off of trying to get 100% return on your money in 1 year and just doing something small and incremental every single day or every month, like collecting rent checks, you are amazed at those returns when you go back and look at it. And again, if anybody wants to talk more about that later, we can talk about that later.
So, Mike, what if I'm drowning in about $50,000 in student loans? Should I still consider an FHA loan? I mean, what if I'm drowning in debt?
So I'll answer that in a couple ways. One, ask your accountant. Two, I'll tell you what, and I'll tell you just a quick story here. And I tell this story all the time because I think I wish somebody had told me this story. When I graduated college, I graduated with $120,000 in student loan debt. So you want to talk about drowning in student loan debt? I'm a good person to ask. And I super aggressively paid that off as fast as I could. And I'm about to turn 35. So it took me 10 years of every commission check and bonus check and hustle that I did to pay that student loan off. Man, I wish I could go back to the beginning of that and start acquiring assets with that $120,000 that I dumped towards strict debt reduction. And those assets would be paying that debt off with room to spare right now had I taken that approach. So the answer is, first, consult an accountant seriously. Make sure it's right for you. But two, make sure that you're being safe. I do fully endorse having a little bit of emergency money first before going down this road. But then, to answer your question, should debt stop you from acquiring assets? Absolutely not. Debt should never stop you from acquiring assets.
Great point. Absolutely great point.
All right. Anything else on this one? You want to move on to the next one?
No, I'm ready. So
this is our favorite one.
To kind of bring it home and to tell you why we love to work with you guys who are considering or have additional questions even after this is done, and working with us here at Fairway, I think would be a great asset to help you guys out in a process like this. we offer a wide variety of loan products, and we're extremely knowledgeable about these loan products. Not everybody's a cookie cutter deal where, everything fits in this round, in this square box. So for the mortgage, or for looking at a process like this, you really want to work with somebody that knows how to accommodate to all different angles and what you're looking at. And I believe our team here in St. Louis, we're all licensed in Illinois and again, a few states across the region here. So we've got a lot of experience here to help educate you guys through this process, guide you through everything, make you feel comfortable from start to finish. And one of the best things I like about this company is, we pay it forward too. So not only do we do various charity events, but one of the things that we do is, if you're a veteran or active military, is we give you additional incentives off of our loan products. Again, love to talk to you in more depth of what that might be, if that pertains to you. But, between our technology, our speed to response, our programs, and our knowledge of the overall market and what process you're going to go through, I think you'd be happy in talking to either one of us here and helping you out with this. So
I want to add to that as well, because this, again, is my favorite slide. But to be perfectly honest, any lender could throw these three things on a slide and claim that they're true. So I want to take a step back and explain why with Fairway those things are true. I related a lot back to our core values, and I've never seen a company that lives by their core values the way this company does. And our core values are things like humility first, have fun, create an amazing experience for the clients, foster growth and knowledge. And probably my favorite one, because in a corporation, you never see speed to respond as a core value.
Yeah,
and that's my favorite one. So how are we able to do all these things? How are we able to educate you, guide you, and offer you things that other lenders can't? Well, we value speed to respond. We value getting back to you. We value being committed to serve. And so that's a little bit about us. And if anybody else has specific questions about Fairway, I'm happy to answer them. I'll take Brian Robinson's questions. Do you offer 203K loans and have access to down payment assistance programs? Absolutely, yeah. 203K loans we can do. DPAs, down payment assistance programs, vary city by city, county by county. So in the states that we're licensed in, yes, we do have access to down payment assistance programs, including, if you have a specific one in mind, just let us know.
Yeah, I think there's a good program.
I'm sorry, can you explain what a 203K loan is? Because, I actually didn't know what this was until last year.
Cool, yeah.
Yeah. So Jeff, 203K loan is if you're looking at a home that, it could be a HUD home. It could be a home that's just got foreclosed on. It could be a home that is just a really good deal, but, you need a little bit extra TLC before actually getting in the home. And basically what you can do limited or standard 203K and finance in some of the rehab costs, if not all of them, into the mortgage. And you're purchasing a home, let's just say for $200,000, you can do a 203K loan for, let's say, $30,000. Put in a couple extra dollars and hire some contractors to help increase that property value and to make the home a dream home for you at putting in $30,000 plus extra into the home.
Yeah, it's a heck of a product. It's a lot of work. Everything that you do to the property is documented, verified. We send an appraiser out there a few times to make sure the work is being done. But if you truly want to buy a property that you want to live in and fix up over time, that's what the 203K loan is for. It's a renovation loan. Federico, you got some great questions, man. Is there a specific length of time I need to live in the property before I can move on to buying another property?
Yeah, guys, the answer to that one, Federico, is 12 months. So you're gonna sign at closing that you're going to live in the property after 12 months. I always joke around and say after the 12 months, no one's gonna send the mortgage police after you and verify that. But yeah, you're agreeing to live in the property as a primary residence in order to take advantage of the 3.5% down payment on these multi-unit properties. You're agreeing to live in the home for 12 months.
Now, I know this can be a gray area, and as a tax professional, I like loopholes. So when you say live in it, can you please define what it means by live in it? What if the property has a basement? Can I live in a basement?
I think that's something that you, as a buyer, decide. And you know, if you're going to live in the property, like I said, you know, we don't have a mortgage police department that does anything on that end. So
you're not the IRS, in other words.
No, we're not. we don't have that arm, the enforcement arm. You know, honestly, it's basically the honor system. There are certain things that are done to make sure that what you're claiming you're going to do makes sense. And certainly, if we're mailing your statement there and you're never getting it because you don't live there, that'd be an issue. But no, I mean, yeah. So you want to live in the basement? You're still living there. You know, it's still the key is it's got to be your primary residence, right? So you got to be getting, you got to be accessible there. But to be honest, I don't have time to go drive to your house and see if you live there after 3 months.
Especially now when you're closing on so many properties in a year, you know.
That's
so
right.
at the, you know, and I think that's mainly why I asked that question, because some people get a little confused as far as, oh, do I have to live in here for the rest of my life? You know, so you answered the question, 12 months, that's all you need to claim as a primary residence.
Let me add that a little bit. Life changes and plans change, and stuff like that's not included in this. So look, if you fully intend to live there for 12 months and then 6 months later you meet the girl of your dreams and elope and move to New York, that's okay. You know, it was your intention. They're going to sign a statement of intent at closing that you plan on living there for the next 12 months, but life happens. So if you need to move, you need to move.
Viewer number 5, once you're locked into a loan, are there restrictions on changing jobs? I've been told lenders call to check jobs after 6 months of being closed. No, you know, once locked in, would be something different, let's say, than closing. So once you're locked in on a loan, let's say after you close on your property, you know, there's nothing that a lender could do to take over their mortgage or your home unless you stop making payments. So as long as the payments are being made, that's your home, and you'll continue to do with it as you please. How much closing?
Federico, I believe. Okay, so again, responding to viewer 5's question, I can go a little bit of background about that. So sometimes lenders are calling to check on you after 6 months, but sometimes lenders are calling to check on your loan officer after 6 months to make sure whatever representations we made, they're basically auditing that. So, you know, if you have a rate locked and you're going to closing, that's not the time to change jobs. If you close and again 2 months later life happens and you get another job, that's perfectly fine. So that's a little differentiation there. How much closing assistance from the seller can I get on an FHA loan? Double versus fourplex, it's the same guideline. And that's a good question. I believe that guideline is 6%. However, Steve is going to double check me right here, looking at seller contributions for FHA properties. I'm pretty sure it's 6%, but he'll double check and we'll get you 100% answer by the end of this. And I believe it's the same, a double versus a fourplex. Any other questions while Steve's looking that up for me?
Yeah, you're
so
right.
for those who are in here, so, you know, thank you all for tuning in. For those that join a little later, if you do have a question, please, by all means, type it in the chat box. We're getting a lot of questions coming through. We will be ending at 6:45 on a dot. I do have a radio show to get to later. But we will, you know, ultimately, if you do have any questions, please feel free to type it in the chat box. Due to a lot of different things and noise, you know, noise cancellations and all that, we are muting everybody else. But if you do have a question, please feel free to type it in the chat box.
If somebody wants to elaborate on a question, can they type in the chat box that kind of raise their hand and say, hey, can you unmute me? Is that cool?
Yeah, that's fine. Absolutely.
So if somebody wants to have something they want to talk through, we can unmute you specifically. Just let us know. Brian Robinson asks, I've heard with down payment assistance, there are restrictions on the number of units, usually 1 to 2. Is this true? This varies heavily by what type of down payment assistance you're talking about. So that is a very, very specific question, depending on the program.
the funding available
And the funding.
through the program. A lot of the programs will offer it, and it can be even seasonal too, and when the funding's there. So it really depends on, as far as FHA, no, we don't have a guideline, or there's not a restriction on where the funding is coming from for your down payment. It could all be gifted. It could come from an employer if he's relocating. It could come from down payment assistance. So FHA does not have a restriction on where your down payment is coming from the down payment assistance program. That's fine. They have other restrictions, so you can't just pull mattress money out and pay for it all with cash. So there are some restrictions, but down payment assistance, the 100% can come from up to 4 units, to 3.5%.
So you mean to tell me if I have $10,000 under my mattress, I can't put it towards a down payment?
No, I'm sorry, you cannot. You might have to season that money in a bank account for 2 months. And that would be a way that the seasoning requirement would be met to where you could use that. So not today, but maybe in 2 months, Jeff.
Okay, and then I think we missed a question from one of my close colleagues. That after closing an FHA loan, can I add people to the title?
Well, yeah, that's more of a, once you close on your FHA loan, what you do with your title after that is really your business. Again, we can't follow up. So that really is a legal question. My understanding is yes, you can add people to title. You just can't pull anybody who's on the loan off a title.
Yeah, and what a lot of people will do potentially with these investment properties is they'll seek to put their title in some type of trust or LLC to protect themselves, which are all great questions for a title consultant. We can
let Jeff answer that one.
Yeah, we can help as much as we can on the logistics of it, and if we're okay on the mortgage side, but there's experts that can go a lot deeper than what Mike or I might be able to about your title requirements and what you can do. Okay,
and as far as Fairway, so have you ever experienced a due on sale? Like maybe somebody did try to deed their property to their LLC by switching the title over. Or I guess they stayed on the loan, but they deeded the property or they gave some ownership to their LLC to have some sort of protection. Have you ever seen a loan get called or, a due on sale clause on that?
We haven't personally seen it, but I understand that it can happen. So that's a tricky thing for us to talk about. And I've heard people, want to do that and their lawyers told them not to for those reasons. But I have not seen that personally happen.
That's good. Good to know.
All right. So how long do you have to work at a job to apply for a FHA 203K? It's not a hard and fast restriction. What you're looking at there is job stability and income stability, which are two separate things. We're going to ask questions like, okay, well, you've been at this job for 3 months, but what were you doing before that? And if it was the exact same job, just with a different company, that's a different answer than, I used to be a real estate agent. And now I'm a doctor. That's a different transition. So it's really case by case, underwriter discretion on that. There isn't a hard and fast rule.
So I have a slight issue with that.
Okay.
So let's say I'm a business owner, and I don't have any stated, or let's say I don't have a W-2. I'm a very aggressive, taxpayer. Meaning I don't pay taxes, so I like to write off everything. So what about, do you guys have options for me?
Yeah, you guys are our favorite clients, actually.
Absolutely. Challenge us, why don't you? Yeah, definitely. That's case by case. Let me talk about that for a second, because that's a big one. When you are self-employed, you unfortunately get underwritten by different rules. So we are looking at usually net income. This could be a very, very long answer. We're going to dig through your tax returns and we're going to understand what's going on. So if you are showing a loss and it's because you're claiming an appropriate level of depreciation, we're going to add stuff like that back. If you're truly losing money, writing off everything as an expense and you don't show any money, the money that you do show is going to qualify you. And if that's enough to cover the mortgage payment and the other debts, you're going to qualify. generally speaking, you have to be at whatever business you are doing, you have to be at that business for 2 years in order to count it as income. So if you are self-employed and you've been running your own business for 1 year, you will not qualify. If you've been doing it for 2 years and you can show income that is stable or increasing, and it's enough to qualify for the loan, then you will qualify. It is difficult these days for business owners to qualify for residential real estate financing, but it is not impossible. We do it every day.
Yeah, and one thing I'd just like to add on to what Mike said is, we're talking about an FHA multi-unit home. So, as little as 3.5% down on a down payment is pretty aggressive on your loan to value. It's a little skin in the game for us as a buyer. So, as you're looking at this product of FHA, singling it out, there are alternate income documentation processes that we might be able to offer to somebody that has less than 2 years of self-employment, but it just may not be with the 3.5% down using on a multifamily unit home.
There's actually another question that came up here that helps to answer this one. Are the interest rate higher when purchasing under an LLC? We can't do a residential mortgage under an LLC. We can only do it under a person's name. So once you start getting into an LLC, and again, if you're a business owner, you may want to look at commercial financing, which we do not do personally. I have got myself a commercial loan from a different bank before, so I know the process. But we don't do loan. We can't do a loan in an LLC. All right, let's go back and make sure we didn't miss any questions. Okay, what tools did you all use to learn about real estate in general, books, title, websites? Let's each take a second and answer that.
Yeah, I think I was fortunate to be in a place where I really immersed myself with a lot of people that were in the industry, and I was at a different bank where I was originating, 30 deals a month almost, and I really got to soak up a lot of networking. So I would answer that question with people, just other people using their past experience and what they've gone through. And then I don't know if it's pertaining to mortgage industry or not, but really dig into the guidelines. A lot of these Fannie, Freddie, and Ginnie guidelines are online, and you can look up the handbooks if you want to dive deep into some of the regulations and rules about it.
So I love this question. First of all, I think it's a really good one, and it would probably take me all day to answer it thoroughly. But kind of like Steve, we've grown up in this industry, so we've been around it. I'm also lucky enough to have an uncle that kind of was like, I don't know if anybody's read Rich Dad, Poor Dad, but that's a really good place to start, by Robert Kiyosaki. And I had an uncle that was kind of like that rich dad. He wasn't rich, but he had that same mentality of, hey, you know what? It's about cash flow. It's about acquiring assets. So I've read, not to go all Ron Burgundy on you here, but I've read a lot of books. And if I could just pick a few of my favorites, that one was very influential to me. There was another one called The Millionaire Real Estate, or The Millionaire Homeowner Next Door, I think, something like that. That was just about, hey, you buy a house, you live in it, you upgrade, you buy the next house, you rent that one out. And just by acquiring real estate very organically, you can look up one day and be a millionaire. That was another one. But really, I think our perspective being in this industry has really helped us. Making sure we don't miss any questions here.
I saw one about using the income from rental. Yes, so we can use 75% of what the tenants are going to pay for rent. So there's two ways we can get that number. It could be from a lease agreement. Maybe there's already a tenant in the home that you're purchasing, and let's say it's $1,000 a month. We use 75% of that, or $750, to help offset the housing expense. The other way is
Quick question. So I'm actually, I mentioned earlier, I'm actually closing on a property tomorrow. It's a 3-unit building. And the bank actually told me that they cannot use because we currently have a tenant in the property. It's a 3-unit building. It has a tenant in there. And they said they cannot use any of that money that the tenant is paying towards the loan rules or the reserves or anything, because the lease wasn't in our name. I mean, Does that sound strange to you?
Yeah, are you doing an FHA, an FHA?
So part of so basically part of the funds are generated from an FHA loan. That is correct.
Yeah, that bank has what we call as an additional overlay. So a lot of times when you know, and I don't know what bank you're working with, but you know, Mike and I both came from a national big bank, and we had additional guidelines that we had to go by, and we call those overlays.
Let me ask this: is there something in the lease that blocks transferability of the landlord? Meaning,
absolutely not. All leases will be transferred at closing tomorrow.
Then then that doesn't make sense.
Yeah, then I would say it's a potential overlay that bank has, or a potential guideline that has, or you know, the other
misunderstanding.
Yeah, or misunderstanding. Yeah, the other thing I was going to say is, you know, one other way we can generate the rental income. So if there's not a lease, we'll do a cost analysis approach through the appraisal. So basically, you pay an additional fee for the appraiser. And they look, you know, just like they look at comps for what a property value is, they look at comps for what something comparable would rent out for.
Interesting.
Typically, you need
wanted to make sure that that wasn't something that was out there, but I'm glad to know that at least some properties factor in the rental income.
Sure.
Yeah.
And it's different if you have a 2-year history of being a landlord than if you don't. The latter one that Steve mentioned, the cost analysis, comparable property analysis, that comes into play if you've already been a landlord. It's a little different if this is your first property.
Yep.
Thank you, guys. There was one more. Can you purchase multiple houses in one FHA loan? The answer is no. You can purchase one house that is a multifamily property, but you can't purchase separate deeds, multiple houses in one FHA loan.
You can only have one FHA loan at a time.
Yeah. Viewer 10, thank you guys. I appreciate everybody being here. Our contact information has been strategically pasted on this slide that hopefully you can carry out the last 10 minutes. So please go ahead and reach out to us. Again, I'm the branch manager. Steve is the loan officer. He's the one who actually knows what he's doing. I just like to talk, so he let me join. Thank you, Steve. I appreciate that. And Jeff,
Thanks, Jeff. We appreciate you.
I appreciate the opportunity, guys.
Yes, sir. Not a problem. Thank you guys for tuning in. This webinar will be recorded, so if you missed out on the beginning, please do not worry. This will be recorded if you were on your phone or anything like that. This will be recorded. It will be posted on various platforms. It will be sent out to everyone that's everyone that I have their email that signed up for the webinar. And of course, Mike and Steve's contact information are in here. And I'll say Mike and Steve are great guys. Mike, for example, he put me pretty much on his list for investment properties. And I really appreciate the information that you put out about, how to buy multiple units, similar to what we're doing today. You even share some things about taxes, which is very important, which is where, I come in handy. But I think it's very, working with Fairway, it's truly an honor. And I think that if you are looking to buy your home, your first home, your next home with an FHA loan or a conventional or anything like that, please consider Fairway. Mike is a great guy. Steve is a great guy. And I think we can all come to a common achievement and ultimately build that long-term wealth that we all truly deserve. So thank you all for tuning in tonight. I will be ending the recording right now.